What's the absolute least amount of money you need to live off dividends? Living off dividends is a dream of many investors. It represents true financial independence, where your money works for you rather than the other way around. Not only are you receiving regular income, you never need to sell off your investment, creating a best of both worlds scenario. But how much money do you actually need invested to live off dividends? The answer depends on several important factors, but you might be surprised once you do the math that the number is actually much different than you thought. The key to any plan to live off dividends starts with a clear understanding of your annual expenses. These include your essential costs, like housing, utilities, food, transportation, healthcare, and insurance, as well as discretionary spending on things like travel, hobbies, and dining out. These will of course depend on what type of lifestyle you're trying to achieve. Some people are more than happy with living on a lean budget, and they actually enjoy getting the best bang for their buck, while others want to have plenty of discretionary spending without needing to watch every penny. The more accurately you can estimate your yearly expenses, the more realistic your dividend income goal will be. For instance, if your annual expenses will total $40,000, your dividend portfolio will need to generate at least that amount after taxes to sustain your lifestyle. Dividend yield is the main factor in figuring out how much money you'll need to reach your income goals. It represents the percentage of a stock or fund's price that gets paid out as dividends each year. For example, if you own a stock priced at $100 and it pays an annual dividend of $4, the yield would be 4%. The higher the yield, the less capital you'll need to generate a specific amount of income, but it's important to balance that with the stock or fund's stability and growth potential. Let's take a 4% dividend yield as an example. To generate a $40,000 annual income, you'd need a portfolio worth $1 million. If you're able to achieve a higher yield, say 5%, the amount of capital needed drops to $800,000. On the flip side, if the yield is lower, like 3%, you'd need a larger portfolio, approximately $1.33 million, to hit the same $40,000 income goal. So the higher the yield, the less money you'll need to generate the same amount of income, but it also comes with risks that need to be considered carefully. It's tempting to chase the highest yield to shrink the size of your portfolio, but high yields often come with more risk. Stocks or funds offering unusually high yields might have shaky payouts, a lot of debt, or struggling business fundamentals. Usually, the share price drops for one of these reasons, which ends up pushing the yield higher. For example, if a stock was $100 with a $3 dividend, but its price falls to $25, it might still pay that $3 dividend for the time being, but now the yield is 12%. A better approach is to diversify with dependable dividend stocks, like dividend aristocrats, for example, companies known for consistently raising their dividends. These options provide a steadier income while still offering potential for growth over time. The goal is to invest in companies with improving fundamentals, which should lead to both a rising share price and an increasing dividend. The best way to build a safe and steady dividend income is by focusing mostly on high-quality dividend index funds or ETFs. These give you a lot of diversification, so you're not putting all your eggs in one basket. With this approach, you get a reliable income stream without having to worry too much about one company cutting its dividend and wrecking a big chunk of your income. You can still invest in individual stocks if you want, but it's smart to keep them to about 10% of your portfolio. This lets you pick a few companies you really like without taking on too much risk. By sticking mostly with funds or ETFs and sprinkling in a few individual stocks, you can enjoy the stability of diversification while still having some room to chase a little extra growth or income. One option for generating dividend income is to invest in a dividend fund like SCHD, the Schwab US Dividend ETF, which focuses on high-quality companies that have consistently increased their dividends over the years. This fund offers a relatively attractive yield of about 3.5%, so if your goal is to earn $40,000 annually from dividends, you would need an investment of around $1,143,000. A fund like this gives you a solid mix of income and growth. You'll get steady cash flow from dividends while still having the chance for your investment to grow over time. It's a great option if you want something that provides both stability now and room to grow for the future. Another option is to invest in a broad market index fund like the S&P 500, which represents a bunch of companies across different industries. While it offers a relatively low dividend yield, around 1.25%, most people don't invest in it primarily for the dividends. Instead, they're looking for growth potential. To generate the same $40,000 in annual income from the S&P 500, you'd need to invest roughly $3.2 million. With the S&P 500, you're primarily aiming for long-term capital appreciation rather than immediate income. It's a good choice if you're focused on growing your wealth over time, but it requires a larger investment to produce the same income stream that other high-yielding options might offer. If you're interested in a different strategy, you could spread your investments across a range of companies. For example, investing in Chevron could give you a 4% dividend yield, while McDonald's would provide around 2.5%. Imagine building a growing portfolio with a mix of individual stocks yielding an average of 3.5%. To generate $40,000 in annual income, you'd need about $1.14 million invested. However, experts recommend that you don't invest any more in a single stock than you're willing to lose to help manage risk and protect your portfolio from major losses. Properly evaluating individual stocks requires some knowledge and extensive research and should never be approached with a throw a dart mindset. Taxes can be a big deal when it comes to dividend investing because they can eat into your returns. How much you pay depends on whether your dividends are qualified or ordinary. Qualified dividends come from U.S. companies that meet certain rules. These are taxed at a lower rate, the same as long-term capital gains, which could be anywhere from 0 to 20% depending on your income. Ordinary dividends, like those from some foreign companies or REITs, don't get the lower rate and are taxed as regular income. Your income tax bracket also matters. If you're in a lower bracket, you might pay little to nothing on qualified dividends, but higher earners will owe more. One way to avoid some of this tax hit is by using tax advantage accounts, like a Roth IRA or traditional IRA. In a Roth IRA, your dividends grow tax-free, and you won't owe taxes when you take them out during retirement. In a traditional IRA, you don't pay taxes while the money grows, but withdrawals later are taxed as regular income. These accounts are a great way to keep more of your dividend income in your pocket. It's worth knowing a bit about tax strategy since they can really impact your finances, or just talk to a CPA for advice. Inflation is a big factor when figuring out how much dividend income you'll need to live on. Over time, inflation eats away at the buying power of your money, so your portfolio needs to grow just to keep up. Investing in dividend growth stocks, companies that consistently raise their payouts, can help make sure your income keeps pace with rising costs. Another smart move is reinvesting some of your dividends while you're still building your portfolio. This helps create a cushion against inflation and grows your income for the future. Your goal should always be to build a portfolio that grows in value at least at the rate of inflation, with annual dividend payouts that do the same. The amount of money you need to live off dividends is heavily dependent on your lifestyle, location, and goals. Reducing or eliminating major expenses like housing can significantly lower the required income. For example, house hacking, renting out part of your home, or living in a multi-unit property can free up a large portion of your budget, allowing you to rely on less dividend income. Take someone with modest expenses, for instance. If they have a portfolio focused on high-yield investments, they might reach their goal with as little as $500,000. A frugal retiree living in a low-cost area who can maintain their lifestyle on $20,000 per year with a portfolio yielding 4% could make this work. On the flip side, a family with higher expenses, say $80,000 per year, and a more conservative portfolio yielding 3% would need a much larger portfolio, about $2.67 million. This shows how your budget and yield can really affect the amount needed. It might seem like retiring on dividends requires an enormous amount of money, but there are ways to significantly reduce the amount you need. For instance, if you can eliminate your largest expense, typically housing costs, by paying off your mortgage, downsizing, or even house hacking, you can dramatically lower your financial needs. Additionally, creating an extra income stream, such as renting out property, selling a hobby-based product, or starting a small side hustle can provide supplemental income to ease the pressure on your dividend portfolio. Even working part-time in something flexible and enjoyable, like dog walking, pet sitting, or freelance work, can help bridge the gap and make a big difference. Plus, if you're old enough to start collecting Social Security, that added income can cover a significant portion of your expenses, reducing your reliance on dividends. It might not sound like a lot, but a retired couple both getting the average Social Security check would bring in about $2,000 each per month. That's $48,000 a year together. When you combine these strategies, you'll find that retiring on dividends might not require as much as you originally thought. The key is to think creatively, optimize your expenses, and plan for additional income sources. It comes with challenges, but nothing too overwhelming. By doing one of these things, many people will find that they can comfortably live on $20,000 or so from their dividend portfolio. Assuming you can safely earn a 3 to 5% dividend yield, that means somewhere between $400,000 and $700,000 needed. Living off dividends is totally doable with the right planning and a realistic outlook. Sure, you're not going to throw your money into a stock paying 10% and retire overnight, but dividend investing is still a solid way to build wealth. How much you need depends on your lifestyle, but the basics are the same. Stick with strong companies or funds that have solid fundamentals and growing dividends. By knowing your expenses and planning for things like taxes and inflation, you can set yourself up for financial freedom and a steady income for years to come.